In this video, we're going to review the accounting for impairments when it comes to one of the three categories. The category we're studying is property, plant, and equipment, along with intangible assets with finite lives. So basically, the accounting for impairment are the same for PPE and for finite life intangible assets. But before we can start testing for impairment, we have to start with asset grouping. Asset grouping for this category works like this. The firm groups assets at the lowest level of identifiable and independent cash flows. So if cash flows are identifiable and independent for an individual asset, such as a delivery truck, the firm can test the delivery truck for impairment. Alternatively, if the delivery truck is part of a fleet, the delivery fleet could be considered one asset group. The rationale is that the cash flows from an individual truck are dependent on the other trucks in the fleet. Let's look at an example. Booth Brothers Corporation operates concession stands in several sports and performance venues. It supplies the stands with equipment such as cash registers, refrigerators, freezers, stovetops, and frying machines. Currently, Booth has 14 concession contracts with over 100 stands. Our point right here is trying to figure out at what point do we group the assets. Well, Booth Brothers determines that the cash flows from 2 of the 5 stands on one contract, it's the Tiger Town Sports Arena contract, they are operating at a loss. So 2 of the 5 are operating at a loss. 3 of the 5 concession stands are actually profitable when you look at them individually. So the question then becomes, should we look at each of the 5 individually, or should we group the 5 together? The answer to this one is that they have contracted with the arena to provide all 5 stands. Overall, the 5 stands are profitable. The cash flows generated from the contract and the 3 profitable stands are not independent of the other ones. So they have identifiable cash flows. They're grouped at this group level. All 5 stands are grouped together. After identifying the asset group, the firm then determines if impairment test is required. If impairment testing is required, then there is a 2-step test to determine if there's an impairment. Firms conduct an impairment test for this category whenever events and circumstances referred to as impairment indicators indicate that an asset may be impaired. Let's look at some of those recommended impairment indicators from FASB. So we will test this category whenever several of these, one or more of these is present. So, for example, there's a significant decrease in the market price of a long-lived asset or an asset group. There's an adverse change in the extent or the manner in which the asset group is being used or in its physical condition. There's an adverse change in legal factors or in the business climate that could affect the value of the long-lived asset. An accumulation of costs significantly in excess of the amount originally expected for the acquisition or construction of a long-lived asset. Let's look at E, a current period operating cash flow combined with a history of operating or cash flows or projection that demonstrates continuing losses associated. So just having one period of a cash flow loss does not necessarily indicate an impairment, but if we have a series of cash flow losses or a projection of future cash flow losses, then we have an impairment indicator present. Finally, a current expectation that more likely than not, the asset group will be sold or otherwise disposed of before the end of its previously estimated useful life. So far, we've looked at 2 things within this first category. We looked at asset grouping, and second, we looked at when to test for impairment. The next part of this is what is the impairment test itself. So in this case, we have a 2-step impairment test. We have the first step where we assess recoverability, and then there's a second step, if needed, where we compare the carrying value to the fair value. If the impairment indicators suggest an impairment of long-term operating assets, the firm assesses the asset's recoverability. In general, the recoverability of an asset refers to its ability to recover the asset's carrying value based on the sum of future the undiscounted cash flows from its use in disposal. So if the total of undiscounted future cash flows is less than the carrying value, then we have a problem. The asset is impaired, and the company must measure the impairment loss. Okay, so then we proceed to step 2. If the sum of the undiscounted cash flow exceeds the carrying value, then the asset's not impaired. So this first step, basically, it gives us just a rough estimate if there might be an impairment. So we already went through the indicators suggest there is, and then we do this little test and we see if there's more evidence that there's an impairment. When the asset's carrying value is greater than its fair value, there's going to be an impairment loss, and it's simply carrying value less the fair value. The asset's fair value is the amount the asset will receive from the sale of the asset in a current transaction between willing parties. How do we find this? Quoted prices in active markets are the best evidence. If market prices are not available, then use information available or use other valuation techniques. So we may have market comparables. We can review recent transactions, and a popular method is discounting cash flows. We look at all future cash flows expected from a particular asset or asset group, and we use time value of money to find its present value. So when we get into the accounting of this, there's a couple things we have to keep track of. First, we have to record the loss. But second, we have to keep up with any accumulated depreciation that may be involved. So basically, we debit the loss, we debit the total accumulated depreciation to date, and we credit the asset for the sum of those two things. This will assure that the carrying value goes to its correct amount, which is fair value. There'll be no accumulated depreciation, so it's like they're starting over. So look at it in terms of the steps here. First, we do some asset grouping. Second, are the impairment indicators present? Yes, then we test. Use step 1, used undiscounted cash flows. If there's no problem, there's no impairment loss, we stop. If the asset's carrying value indicates that we have a problem, we go on to step 2, and in this case, we simply take the carrying value minus fair value to find the impairment loss.